wanted to take a look at real assets because they did have a really nice 2021. And if you look at the energy market here on the left side, energy was up 52% for the year, even though for the quarter it was down 13%. And so for the year, we had a big rebound over what we saw in 2020 when, at the beginning of the pandemic, people stopped driving and flying and doing all of those things that consume energy. And so in 2021, when we resumed some of those activities, we did get a big boost in demand for energy. At the same time, OPEC rather liked having the high prices and did not increase supply as fast as expected. And so that created a bit of a supply crunch at the same time that demand was coming back online, which sent prices higher. So this does go into the inflation number. A 52% increase in energy cost is a big increase. However, if energy prices just stay where they are, that will, by definition, create zero inflation from this part of the economy. So energy prices are not expected to increase another 52% this year. And so because inflation is just the change year over year in prices, we do expect to see some softening in this part of the inflation number. If you look at industrial metals, up 30% for the year. These are things like copper and aluminum, things that actually go into building things and creating goods. There was also a big surge in demand from that. And so we saw base metal prices hitting prices we haven't seen in over a decade. So a really strong recovery there. And again, part of the inflation number, but if the prices just stay where they are, that won't create additional inflation. Precious metals were actually down 6% for the year. We talked about this a few quarters ago, where when people expect inflation, they typically buy gold. That's when you see the price of gold going up when inflation is expected. But once you get inflation realized and you get interest rates start to move, people start to sell gold. And so once you see inflation, precious metals tend to not actually do that well, and that's why they were down about 6% for the year. We also saw increases in the price of agriculture, up 27% for the year. I'm sure you all noticed this at the grocery store where food prices was going up, uh, and up another 6% for the quarter. But again, if prices just stay where they are, then inflation will start to moderate. On the right side, we see REITs. REITs did really well for the year, so up 16% for the quarter and 43% in 2021. And I just wanted to point out that a lot of this was driven by sectors that were hardest hit during the pandemic. So you can see residential real estate up 58% for the year, retail up 52%, and office space even up 22%. So a lot of those parts of the REIT market that suffered did recover in 2022. In this chart, I really wanted to highlight the bottom, and that's over the last 20 years. Pretty much all asset classes have done really well. REITs were the biggest winner over the last 20 years, and emerging market equity right behind it. And so I just wanted to remind you that the trends that you see in the short term, like large caps outperforming domestic, outperforming international, those are short term trends, but over the long term, REITs and emerging markets and small caps have actually done the best over the last 20 years. And then that dark green bar shows what the average investor experience has been. These are investors that are investing in the stock market. So they're actually taking risk, but the return is only 2.9%. So barely keeping up with inflation because they buy and sell at the wrong time. So investors tend to get nervous when there's a sell off and sell after prices have already moved down. And they're reluctant to get back in until prices have largely recovered. And so that doesn't leave a lot of room to make a lot of money in the market. And so the moral of the story here is have a long-term plan. Know what risk you can tolerate in your portfolio, invest accordingly, and then stick to it. And don't be tempted to buy when the market starts to run up a lot and sell when the market sells off. Uh, don't be the average investor. And if you get nervous about that, if you want to come up with a plan or review your plan, which is a good idea to do pretty regularly, reach out to your relationship manager. That's what we do. We love to make sure that you're on the right track and that you're sticking to your plan, and we can adjust accordingly as your circumstances change. And then lastly, I just wanted to highlight the impact of inflation here and the fact that interest rates are not what they were 15 or 20 years ago. So this chart shows income earned on savings accounts. And the most recent data point there, if you have $100,000 in a savings account, you're only earning $70 in interest, and you need to earn $5,000 to keep up with inflation right now. And so, for money that you need to keep up with inflation for long term planning and long term spending needs, that needs to be invested. It cannot be sitting in cash, or you're not going to keep up with inflation. For money that you plan to spend in the next year or two, we do recommend that you keep that in cash because, of course, you shouldn't be exposing cash that you need to spend to risk. So set that aside, but then the rest, come up with your financial plan and then come up with a plan to invest it because right now, savings rates are not keeping up with inflation. If you have any questions on any of that, please feel free to reach out to us. We'd love to hear from you.